of transfer pricing and therefore take a closer look at the OECD transfer pricing guidelines. At the end of this video, you will have a comprehensive overview of what the OECD is, how the OECD guideline is structured, and the key issues addressed, including practical approaches provided by the guidelines. Therefore, this video provides you with the optimal foundation to continue to examine the interesting topics for multinational enterprises regarding transfer pricing. The structure of the OECD transfer pricing guidelines can be divided into 5 main parts. First, an introduction, consisting of a foreword, a preface, and a glossary. Second, the general mechanics of determining the arm's length prices are illustrated. This important part consists of a guidance for applying the arm's length principle, the 5 transfer pricing methods, and a comparability analysis. Following with the important topic of an appropriate transfer pricing documentation and address formal issues such as avoiding and resolving transfer pricing disputes. Additionally, specific transactions such as intangibles, intragroup services, cost contribution agreement, business restructurings, and finally the newest chapter about financial transactions are addressed and covered by the guidelines. Lastly, the annexes for the covered chapter are listed in the OECD transfer pricing guidelines. Let's start and jump into the first chapter with the introduction of the arm's length principle. Chapter 1 discusses some fundamental concepts and introduces the arm's length principle. It can be defined as a basic rule that transfers must be made at arm's length prices, which means that associated enterprises set their prices as they would be charged between independent parties in the same circumstances. The chapter provides tools for understanding the financial and economic relations between parties, how to accurately describe the actual transaction when facts differ from contractual agreements, and how to identify specific risks, who is assuming them, who is controlling them, and who has the financial capacity to bear them. Furthermore, the guideline discusses some fundamental concepts such as comparability, recharacterization, loss-making companies, government policies, and customs valuations. For example, the comparability analysis ensures that an intercompany transaction is compared with a comparable transaction with third parties. In Chapter 1 we learned that the goal is to find arm's length prices for controlled transactions. This can be achieved by applying the so-called transfer pricing methods, which are described in detail in Chapter 2. There are 5 main methods to find arm's length prices. First, the so-called traditional transaction method with the cup method, the resale minus method, and the cost plus method. Second, there are the transactional profit methods with the TNNM and profit split method. Chapter 2 describes them and explains how to select the most appropriate one. In Chapter 3 the guidelines suggest how to do a comparability analysis after a company has described the actual transaction and has established the significant comparability factors. It also suggests when to do it, before, the price-setting approach, or after, the outcome testing approach, and discusses various compliance issues. There are typically 9 steps to performing a comparability analysis, bearing in mind the 5 comparability factors at each relevant step. Chapter 4, Administrative Approaches to Avoiding and Resolving Transfer Pricing Disputes. The Chapter 4 in the guidelines addresses the governments on 2 main topics. Compliance, including transfer pricing compliance practices, safe harbors, and simultaneous tax audits, and dispute prevention and resolution, APAs, MAPs, corresponding adjustments. And arbitration. The process of documentation and the requirements are described in the Chapter 5. The documentation serves 3 purposes. It is a risk assessment and an audit tool for governments, and it proves that the taxpayer has a considered transfer pricing policy. The OECD Transfer Pricing Guidelines proposes a 3-tier system, a general overall master file, more specific individual country files, and a country-by-country report. From the following chapters, the transfer pricing guidelines deal with the specific transactions, starting with Chapter 6 on intangibles. The intangibles need to be identified together with their owners and parties contributing to their value. The proceeds from the use or sale of those intangibles then need to be allocated to those parties based on the value of their contributions and the risks assumed by them. An intangible is something that is not a physical or a financial asset, is capable of being owned or controlled for use in commercial activities, and the use or transfer would be compensated in a transaction between independent parties in comparable circumstances. For example, patents, know-how and trade secrets. Intragroup services are discussed in Chapter 7. The chapter deals with primary issues, such as identifying whether intragroup services were provided and determining their arm's length charge. The chapter also provides reduced documentation requirements and a safe harbor markup for certain low-value-adding intragroup services. Chapter 8 is about cost contribution arrangements. The Chapter 8 provides a definition and overview of cost contribution agreements. It describes how to test them to the arm's length principle and how to make adjustments where needed. It also addresses issues regarding entering and leaving a cost contribution agreement and structuring and documenting cost contribution agreements. Chapter 9, Transfer Pricing Aspects of Business Restructurings. While governments cannot tell MNEs how to restructure their business, they can require that when taxpayers give up their future profits to group companies, they do it for the same price as for which they would give up those profits to third parties. The Chapter 8 defines business restructurings, discusses the link between risk, profits, and the transfer of both, and shows how to determine arm's length payments at the time of the restructuring and thereafter. It argues when transactions should be recharacterized and provides a number of examples of business restructurings. A business restructuring is the cross-border redeployment by an MNE of functions, assets, and/or risks. It may involve the transfer of intangibles, or the renegotiation of existing arrangements. The in 2020 published Chapter 10, Transfer Pricing Aspects of Financial Transactions. Finally, the Chapter 10 covers the accurate delineation of financial transactions, with respect to multinational enterprises' capital structures. The chapter addresses specific issues related to the pricing of financial transactions. The chapter is divided into 5 main sections, including: first, the guidelines application of the arm's length principle on financial transactions. Second, treasury function, including related transactions such as intragroup loans, cash pooling and hedging. Third, financial guarantees. Fourth, captive insurance and lastly the determination of the risk-free and risk-adjusted interest rate.